So welcome everybody. We're going to talk real estate today. We're going to talk commercial real estate today. So some ideas that, I think we should all be aware of, and I know we have about 40 minutes, is to really chop a lot of wood here, really get everybody comfortable with what's going on in the real estate business, right? Specifically commercial real estate. And we'll try and talk a lot about what's taking place here in San Francisco. A couple ideas just to sort of set the table. We borrow money, right, to build a building. We borrow money to rehab a building. We borrow money to buy the land to build the building. We have to refinance that property at some point in time in the future. So today, rates, if you're going to go out into the general market and borrow dollars, are right around 4% if you're thinking about the 10-year treasury, because that tends to be the benchmark for borrowing for commercial real estate. And the prime rate, because everybody always wonders, okay, where's the prime at that point for obviously the best buyers? That's at an 8.25. And then we think about inflation. Well, if you're thinking about inflation, you've got to be thinking about energy. The WTI, which is the oil pricing right now, is right around $72 a barrel. So inflation in oil and West Texas crude intermediate is really important to understanding, okay, where will inflation be later? And then lumber, right? We have to build a building. So if you're not just using pure steel and it's not modular and it's not built in a factory and it's not AI, you got to think about lumber prices. So today lumber prices are right around $565 for 1,000 feet. So those are just sort of the bedrocks of, okay, what are you thinking about when you're starting to put real estate together? So today, real estate as sort of an asset class is about $9 trillion in global assets. So when you have an industry and you start to include residential into that, you have a greater value than you've ever had before. So commercial resi really going up in value, and it sets a really nice bedrock. Family offices, those of you that are in the room today or those of you that are watching, you really need to think about broadening your horizons, broadening where you're going to be investing. Most family offices tend to be very niche-y. They tend to go to one or two asset classes. They don't venture out. They don't really think about the other areas. What we're going to talk about today are all of those areas that you should be investing in. Life science properties, production studios, data centers, cold storage. These are all amazing asset classes for you as a family office to be diversifying in. And then finally, going into this year, going into the second and third and fourth quarter of this year, from what I'm reading from CBRE and what I'm reading from some of the other, really good research shops, is that the capital heavy intensive program that we saw going into fourth quarter last year will continue into this year. So there's going to be a lot of money in motion. And when there's a lot of money in motion, it means there's going to be a lot of loans being made, a lot of properties being put up in the air, going vertical. And there's going to be a lot of opportunity for you as a family office to really get involved in commercial real estate. So with that, I just wanted to sort of set the stage. Let me make a couple introductions. For myself, I've been in commercial real estate for the past 20 years. I've worked for Guggenheim and BlackRock. I've worked for Merrill Lynch and UBS, always securitizing real estate, raising money for real estate deals. So I've been around real estate basically my entire career. To my left, how are you, Jay? Nice to see you, is Jay Shaffer. Jay is a local San Francisco native. He works in the area. He's got a team of 12. And he's responsible for, and he'll talk about his background, being able to go into a building, find tenants, secure long-term leasing for those tenants, put them into the building and lease it up. So what does that do to the building? It increases its NOI, it increases its cash flow, and it makes it a better property and also a better community. So he's going to talk a lot about what takes place in leasing, office, flex real estate as well. So I'm going to allow him to really tell us boots on the ground, what's going on, who's coming, who's going, and who's leaving. And then down to my left-hand side, obviously, I've got my good friend, Dr. Lawrence Souza. Larry and I have known each other for quite a while. He's got an amazing background, which I think he's going to be able to share with us in terms of economics. And Larry is involved in a lot of things, which I think brings a lot of breadth and depth to the real estate area that we're going to talk about today. I mean, he's a real estate broker, financial economist. He's a teacher. He's an advisor. He does white papers and research. So make sure you check out his LinkedIn profile for some of those. And he got his PhD at Golden Gate University. So he's going to talk a lot today about multifamily logistics, capital lending, storage, capital rates, supply changes, life science. So there's just so much, I think, that Larry's going to bring to the table and help us in terms of, again, setting the table and understanding as a family office how money is invested in the asset class, and more importantly, what we should be doing with it over the next 10, 15, 20 years. And then to my right is Ken Kecskes. Nice to see you. Ken and I have also done a few panels today. And Ken and his firm, K&L Gates, obviously is sponsoring this program today and allowing all of us to be here at their offices. So thank you very much for that. Ken's practice, and I've spoken to Ken so many times about real estate and really just sort of the structure of the deal. And I think that's what Ken's going to talk a lot about today is the structure of the deal is so important. How do you get it right? How do you buy right? How do you position right? How do you negotiate correctly? Because if you're not structuring the deal correctly on the buy side, while you're managing the building and later selling the building, it's just not going to work. I'm going to talk a little bit, or he's going to talk a little bit about joint ventures, the entity formation, the acquisition, and more importantly, the disposition. How do you make money coming out, or are you just refinancing and taking capital off the table? So for the last 25 years, he's been working for family offices and really helping with facilitating lending, facilitating bridge, and more importantly, when you're putting together a property, you want to buy the property, finance the property, or you're thinking about, maybe selling that property, you've got to get your capital stack correct. How do you get your debt right? How do you get your equity right? How do you get your bridge loans right? What about your JV investors? What about your personal money coming and going? So being able to build a really good capital structure coming and going is so important for real estate. So I just wanted to set the table, and we'll sort of start off with you on my left. So Jay, yesterday, Wall Street Journal, lead article. So the lead article reads, nearly a fifth of office space sits vacant, highest on record. The U.S. office is emptier now than at any point in decades. A staggering 19% of all office space in the U.S. sits empty. Well, you're a commercial broker. How are we going to get out of this mess?
It's easy. No, all right. Let me take a quick step back. For those that don't know me, I'm over 20 years of experience in San Francisco. I'm from here, live here, work here, kids go to school here, the whole 9 yards. So I'm very much in the trenches in the Bay Area. Before I talk about that, and I will answer the question, Matthew, if we look back at the last two cycles, by example, crash in 01.com, when was the best time to buy commercial real estate? Well, to avoid venturing guesses out there, folks, it was not till 04. If you bought a property in 2004 and sold it in 2007, you would have doubled, if not tripled, your investment on any kind of commercial real estate you'd bought in 01. Now, it's really hard, though. During 2001, who had the confidence, right, and the balance sheet, to be candid, right, to go out there and acquire those assets? It's really tough when blood's on the street. All right, let's talk about 2008, right? Great Recession. Is that the best time to buy? Short answer is no. It wasn't until 2010 that it was the best time to buy. And if you bought in 10 and sold it almost anywhere along the way up to 2017 at least, it was a phenomenal ride. And so long story short, you can double, triple, quadruple if you do it right, but it takes a lot of risk. And that's not for everybody, right? To be perfectly candid, the risk profile.
Guide the family offices and
well
keep them
said.
out of that risk.
Thank you for the softball. I like that, Matthew. Absolutely. So I'll give you a perfect example. In 2010, we helped a family office. They're based in Hong Kong, but operations here in the city. They bought a Union Square office building, 104,000 feet. We sold it for $23 million. At the time, people thought we were crazy. They're like, how are you buying a building right now? This is not that long into the Great Recession. We obviously bought it right, $230 a foot. Rode the wave, so to speak, but that was a lot of sweat equity, folks. It's not like it happens overnight. And then the last cycle, if you would guess that Dropbox or Tesla or any of these companies would have been around 5 or 10 years before they actually were, I'd say, God bless you. It's really hard for people to see what the future is. Heck, a few years ago, did you know about ChatGPT or OpenAI? Now you do, right? They just leased 500,000 square feet in San Francisco. So it's really hard for people to see the forest through the trees, if you will. So and what we do is pound that pavement.
All right, so let's circle back. So we've got a fifth of office space that's vacant. How are you enticing future, lessees to come into the financial district of San Francisco? What is your hook? What is sort of your theme to bring them in and to say it's okay to rent?
Yeah, there's a few different factors at play. I'd say the first and foremost is, how does any building differentiate itself? It'll start with amenities. right? And so a lot of landlords are amenitizing their buildings. You look here in Embarcadero Center 4, right? You look at all the different 4 buildings that are connected. They've got a gym, they've got that fitness center, they've got conference centers, they have parking, and they're going above and beyond that now. Some people are putting in dry cleaners, massage studios, bicycle repair centers, if you will, but amenitizing buildings. The most notable of which is 525 Market. For those that don't know, that's a 1 million square foot building in and of itself. They're spending $23 million on a full floor amenity building. So Sephora moved out, if you didn't know, 200,000 square foot block came available. Landlord said, how are we going to attract people? This is a New York State teachers retirement fund that owns 525 Market here in San Francisco, and they're spending over $20 million building an amenity floor, right? Because when tenants can choose, and actually I think you said 1/5, it's 35% here. It's almost 2/5 of this city is currently empty. That's a lot of space when you have an 86 million square foot market. And so if you don't build the amenities, you're not going to attract the tenants.
Right. So let me come back to you, Ken. So I know how important it is, as a lawyer and obviously as a client's lawyer, talk about, I think the structure of a deal. How important it is to get it right on the front end, because I think that's really where you win and your client wins. So if you don't mind, would you address that?
Sure. Certainly what we like to do is we like to get involved from the very beginning. And that's at the term stage. So when we're talking about deals like that Jay has been discussing, we're talking about leasing, we're talking about acquiring office buildings, we want to get involved early. We're not necessarily involved on the pricing side. That's what folks like Jay are going to understand better. But understanding how to structure that deal from the very beginning and understanding like what, as you mentioned, Matthew, how is that potential capital stack going to play out? How are you going to build in the amenities that you need? What's that lease going to look like? What are the TIs going to be for that particular opportunity? Those are the kinds of things that we like to get involved in at the very beginning and build into the lease and anticipate how the financing is going to work for the redevelopment or repositioning of a space or the acquisition of a building or development of a building. If let's say it's a spec building on the one hand, you've got an opportunity where you're going to be building out that potential space, or on the other hand, you have build-to-suit. And we're seeing that sometimes here, particularly for corporate users. So, getting involved in the structuring from the outset, super important. And as it unfolds, because, as we all know in the real estate business, there's just so many moving parts on the finance side, the leasing side, as well as what that owner user ultimately wants.
So let's talk about your, I guess, strength. Let's talk about, where you as a firm have a competitive advantage. And you're a global firm versus, say, a smaller local firm. What is that competitive advantage as a real estate lawyer, putting together deals? What is that advantage for you?
Yeah, the benefit of working with a firm like K&L Gates is that we have a global footprint. And so, in the family office space, we are representing folks that are part of either institutional investors or family offices from all over the globe. And money is looking for safe, stable investments. And that's what we can provide in the United States. And in particular, we can provide in the Bay Area. And yes, people will be like, oh my gosh, well, what's going on in San Francisco? The market's starting to stabilize here. And pricing is determinable or getting determinable. And for that reason, capital from all over the world can be interested here in San Francisco. And on the other side of it, what we see institutional investors and family offices that are based here that also want to diversify internationally and look at other real estate markets, whether that's in Europe, whether that's in Asia, whether that's in Australia even, because we have offices there, substantial presence. So the global footprint of K&L Gates allows family offices to move their capital to opportunities globally, and also for family offices who may be abroad, and I know that there may be some on this call, who like to invest in the US or regionally here.
Well said. So let me flip over to you, Larry. You know, I know you as a firm are focused on Pac West, Mountain States, Texas, desert. You're very California or Pac West focused. Why is that?
Well, first I wanted to comment on the office market really quick, and I'll do that. What I thought was really interesting from some of the most recent statistics from CBRE, the office market is segmented between Class A, institutional, Class B, C, and D. The last time I looked, the vacancy rate for Class D and C space in San Francisco was 75%. So there's a lot of distress at that lower level, of the market. We look at the top of the market, mostly the Class A. There's been a flight to quality. But to really look at the distress in the market, you got to look at the lower quality classes. I like the West, California, Pacific Northwest, Vancouver. I like to look at the mountain states and the desert mountain states, Denver, Phoenix, even Salt Lake. There's a synergy between California and those desert mountain states. A lot of the capital doesn't like to go too far, especially into Texas or to the south or Florida. There's a lot of human capital, a lot of physical capital, a lot of employment, synergies between California, the Pacific Northwest, and the desert mountain states. People like to migrate out of California. They don't want to go across the United States. They want to go to Phoenix. They want to go to Vegas.
They do go to Vegas. They do go to Texas. They do go to Florida.
They do, but most of the out-migration, you read about out-migration from California, the majority of the out-migration goes to the desert mountain states.
Gotcha.
So, and if you want to, and a lot of the clients say, well, I want a higher cap rate. I want a higher, income return. Well, yeah, you can go get a higher, cap rate and a higher income return in those commodity markets, but you have to be careful because now we're late in the cycle, particularly for apartments. And a lot of those commodity markets are starting to see higher vacancy rates.
We're definitely going to talk about
So
that.
there's supply risk that a lot of people overlook. They focus more on the demand side, but I'm always scared of, what are the potentials for supply shocks that could cause my NOI to go down and my values to go down at some point in the future.
Could you address logistics as well as capital leasing? I know we've talked about that before, but I just think logistics and capital leasing is so important right now. So you and I talked about that earlier in the week. What are you thinking?
Well, when I hear logistics, I think of the model company like Prologis. And if you look at their strategy, it's freaking brilliant, right? I mean, if you look at the corridors, the transportation corridors, if you just look at the ports of LA and Long Beach, and the arterials that come out of the ports of LA and Long Beach, the economics of the logistics coming out of the ports of LA and Long Beach, those corridors that feed those supply chains, not only up into California, but also into the fast-growing desert mountain states and into Texas. Those corridors, we think mostly geographic and concentric, but if you think about the corridors of that high velocity logistics and transportation, yes, that's where the land intensity is going to occur along those corridors.
I'm definitely going to circle back to that. So let me ask you a question, Jay. You mentioned blood in the water, right? We know that. We've come out of COVID. We've all sort of straightened ourselves. Who were the winners during COVID? COVID was that 2.5, 3 year period. We're out. Who won?
Good question. To be candid, buildings like this, which is owned by Boston Properties, really the only appreciation that we've seen during this process is view space. If you've got this gorgeous, I'll turn around, Baywater view, it is precious commodity here in San Francisco. There's only so many spaces that have views. If you look at what Michael Chavot is doing at Transamerica, case in point, he took a building. Now, granted, we talked about having the balance sheet and the risk appetite, right? Michael Chavot and his firm are investing over $1 billion. That's no small feat, right? Now, granted, that's at scale. We're not talking about B and C, smaller boutique buildings, right, that are easier to get access to. But this is a perfect example. So he's amenitizing the building, bringing in a 50,000 square foot core club in the near future that's under construction. And it's going to be a really interesting, end result to see how it all plays out. Now, that's in motion. 3 years from now, we'll find out how well it works. right? He's making a big $1 billion bet.
And when did that $1 billion bet begin? During COVID?
During COVID.
Just out of?
During COVID. Yep.
During COVID. Who else won?
Yeah.
Salesforce Tower was immune, to everything. Everybody flocked, to
Exactly.
Salesforce Tower.
And who owns that? Boston Properties, who owns Embarcadero. And so some of these landlords can do that.
Who else won during that 3-year period of COVID? Who came out of COVID a winner in your eyes?
Ooh, good question. I would say that multifamily building owners also came out on top, as well as developers of single family residential. They have been able to print money in those markets. So if you were a family office that was interested in developing single family detached product or single family for rent, those are still markets that are winners, going back into the COVID days when people were fleeing from the cities and wanted to have the safety of suburbia, and that is continuing today. And for a little bit different reasons, because of the the high interest rate environment where people are staying put in their residences. And so the new product is really the more attractive product and the available product for folks that are not only entering the home buying zone, but are also moving up.
So talk to me a little bit about housing laws, housing policies. How is that making a difference in residential development? How is that helping?
So California, the last few years, since 2017, but it's been accelerating, really has passed a series of laws to make it easier to build housing. And again, that's a very attractive opportunity for family offices, whether they want to co-invest with a home builder and develop property, or whether they're interested in multifamily product and developing that. Because right now, the local jurisdictions have their feet to the fire to develop more housing stock. Otherwise, the state of California is going to sue them for not performing. That is totally different than it was, 7-10 years ago. Now, local jurisdictions, counties, cities are looking for developers who want to develop product. And if you develop affordable housing in particular, there are a suite of bills that allow for streamlined production of that housing on a much faster pace than ever before. Sometimes ministerial approval, like basically go up to the counter and submit your plans and you get approval. It's not that easy, but it's a lot easier than it was before. And we're talking about projects of a scale where if it's only 10 units, again, very bite-sized for some family offices, ministerial approval up to hundreds of units, could take advantage of density bonus laws where you can get double the amount that this current zoning allows in particular cases. So again, projects that might not pencil under certain circumstances now have a major incentive to include affordable housing. And this is at moderate rates, not just like the very low, but if you build housing with units that are in the moderate category, which again in the Bay Area is like a salary of over $100,000. You build housing for those folks, plus you get double the number of units that you're going to build, which gives you more market rate units to produce higher IRR.
Larry, let me just sort of piggyback him. Let's talk about redevelopment, right? People think about redevelopment a lot. How about redevelopment of old warehouses, factories, schools? How can family offices out here today or watching us online, how can they take advantage of that and maybe find a new niche for them and broaden their portfolio? So talking again about redevelopment of old warehouses, factories, and schools, how can family offices take advantage of that?
I would probably use the private equity side of the market, finding good operators and, good, companies that know how to, go into a value add or an opportunistic, opportunity that have a track record, either in joint ventures or maybe they syndicate funds, for the family offices to participate
I
in.
can hear it in your voice. It doesn't sound like you're a fan. What would you be a fan of if it's not redevelopment awareness? I can just hear it in your voice.
No. I'm looking for the
I wanna know
operator.
where they should be heading. I got
Okay.
$100 million burning a hole in my pocket. Where would you direct your clients?
I'll pick one sector.
Okay.
I like the hotel sector,
Hospitality.
particularly in core markets. Maybe boutique hotels with opportunities to buy, but they have to be destination markets. They were one of the beneficiaries from COVID, definitely. Storage is held up also. So I think that market, as a alternative property sector, not one of the core, that's held up well. The hotels have definitely benefited, and I think they will continue to.
Do I still have
benefit.
legs as a family office with $100 million burning a hole in my pocket?
Again, if you
Advantage of the hospitality?
well, do you want to JV it, or do you want to JV with a private equity
About the JV.
firm? You find a good operator that has a track record, that has experience in doing value add or running stabilized assets. You can participate on a JV side, or if they're raising a Reg D fund, you could do that too. The other ways of participating in the marketplace may be through Delaware statutory trust vehicles. I like the Hamilton Zants guys here in San Francisco. They've done a great job on the apartment side. I'd probably go with them too. I'm looking for sectors, but I'm looking for operators, that can execute. And I like to diversify across operators.
That's
Sector.
like a fund of operator funds.
Yeah, so it's, you have sector diversification, maybe geographic diversification, but I like manager diversification, but the managers have to perform.
Agreed. So Jay, let me ask you a question. Okay, so important. If I'm looking at a building, buying a building, selling a building, refinancing a building, the appraisal is your key, right? I want to take money out of the building. I really need to make sure that the value is there. My loan to cost, my loan to value is there. How should a family office and you in conjunction, let's say you're working together, how do you work properly with an appraiser? You can't guide him. You can't tell him to give you a higher value. But what's the best way for a family office to work with an appraiser on a property?
I'll answer that, and then there is a tangent because you teed up another opportunity there. First off, with appraisers, you can be a little more proactive, and I'd highly recommend that. So by example, if you have a specialist in any given market, let's say me as a San Franciscan, if you will, and a commercial expert, we send those comps to the appraisers all the time, very frequently. And I've yet to have an appraisal during COVID come back less when you're proactive. Now, people that just sit back and wait for the appraisal to come, it's kind of licking your thumb, holding up to the wind and hoping it works out, folks. That's not me. That's not what I recommend. Now, that being said, going back to something that Ken brought up earlier, building a successful team to me is everything. It's not just a real estate broker by any means, right? You need to have a great real estate attorney help you. You need to have a good finance person help you. You need to have a good real estate broker that can help you source the best opportunities. That takes a whole cohort, if you will, architects, contractors, designers, you can go further. And if you have that team, it's a much more successful strategy. Or you go the route of saying, maybe that's not my core specialty, or maybe that's not my risk profile. Maybe we do exactly what you talked about, Larry. And then you're diversifying and going to operators that have the known track record to do it on your behalf. And you're a little less hands-on, right? Either way works. It depends on your risk profile and as well as your expertise.
So let me go back to appraising. So you're in the middle of a deal. The appraisal came in light. Your loan isn't going to be as well as you thought. It's going to be light. The value of the building is going to be light. Well, what can you do to maybe go back a second time for a new appraisal, and possibly either find another firm or maybe go back to the original and say, hey, did you think about? I mean, appraising is so important to the value of a property, the refinancing of a property, the development of a property. So talk a lot about, talk as much as you can sort of about that appraisal aspect and maybe a pitfall that family offices might miss or they should not be careful about in appraising.
Great. The tangent to that me is working with the right lender. Banks are not created equal, everyone. And I'll give you a perfect example. One of my clients bought a building during COVID. For total candor, it's time to fine if I say their name, Russian Hill Academy. So Russian Hill Academy is a private school. Schools still need buildings, right? They're less about the hybrid approach, if you will. You still need to have, a brick and mortar real estate. Well, long story short, we went to Chase to finance the deal. And I'm not trying to, bash a lender and speak up about another. This is just core facts, people. Chase turned down the deal. It was their underwriting department. The appraisal, by the way, came in successfully. And here's the irony. It still didn't make its way through underwriting. And we're literally scratching our heads how the underwriters couldn't get their head around it. But the fact of the matter is, these underwriters are not all created equal. The risk profile of every bank is different right now. And a lot of banks have scaled back. I wouldn't say completely pulled off the market, but their underwriting requirements are much more strict and firm. For those that don't know, I sit on the board of Bank of San Francisco, and Bank of San Francisco was able to step in and do that loan, right? Where Chase wasn't. So if you have a community bank, often those community banks will step in if they can understand the operating relationship.
Yeah.
There's probably a holistic relationship, look at deposits too. And they'll say, hey, if I get the deposits, can I redo this? And maybe Chase doesn't have the creativity.
I think you want to jump in on a.
Oh, I was just thinking
I can
about,
see it.
I was just thinking about, if you have the relationships or you have relationships with the banks, that's great. If you get to work with a good mortgage broker, that can really work, their network, of financial institutions. And maybe the appraisal comes in a little light, and maybe you can't get the full loan to value, but maybe there's an equity piece, or a gap financing piece that can work in a temporary situation to then have the property be reappraised in a year, and then you take out the equity piece.
Exactly right.
So there's a way of
3 years, I could go CMBS for 10 years and take out.
and take it out, and then and structure the deal through the finance.
Appraising, really important. We can talk about that again. So Ken, let me come back to you. I'm going to get back to a topic you raised, which was single family rentals, the built to rent space, co-living. Why is that something that you gravitated to, and why has that become sort of part of your practice?
Well, I think, one of the reasons for the market opportunity is because of the housing affordability problem. And there is an issue in the market for how do you address those folks that can't come up with the down payment that they need to purchase a home, but still want to live in a single family detached unit. And then there's also folks, again, depending on your demographics, who don't want to own property anymore. They want to have someone kind of take care of all the stuff associated with home ownership, and they want to have someone else own that. So that's kind of the market proposition for that. And so for this reason, there has been a greater market opportunity and interest, not only among family offices, but also Wall Street, interested in acquiring single family homes and then maintaining them as rental property, or ground up development where it makes sense. You have to really understand your market when you do that by doing an appropriate market study and placing and building single family for rent, brand new product to meet that market niche.
But don't you think the big funds, let's just pick on Carlyle, let's pick on Blackstone, let's pick on, BlackRock, they're doing that. Are they going to become the new landlord?
They are for some. I think there was a concern that they were buying too many units for a little while. And they still are buying units. In fact, I saw a news article today about how there was a concern about the number of residential units being bought in suburban Chicago and around all the good schools. You got, fancy private equity firms buying up those units because they know where do parents want to go. They want to go move to places where their kids can walk to school.
I knew you were coming.
So you guys saw anything going on with Airbnb? I don't know if it's happening here in San Francisco, but in New York, they've kind of outlawed it.
They have
ground it to a stop.
Exactly. And so that goes to Larry's point earlier. Not yet, but it's been discussed. I think in part, there's a little bit of pushback just because Airbnb is based here, right?
It's already spread like along the east.
But it has. It has, but it's become a market opportunity for family office that want to invest in hotel properties in New York City or in those other markets, because all of that is dried up, depending again on the enforceability of that. And in New York, they have the people to do it.
But New York did it because it now raises.
single family homes isn't analogous to the Airbnb situation.
Well, the difference is that, those homes are long-term lease, just like if you,
Short-term rents, but long-term rents.
Yeah.
right, like if
But
you
that's
bought a
not the
house.
Purpose of what those homes were created for.
It definitely was not, but right now it's very tricky to be able to discern, who is gonna be the ultimate owner of those homes. If you, Marty, bought a house in suburban Chicago as an investment opportunity next to a good school, should you be excluded if you, leased it out on an annual basis? That's the tricky part. So not saying that legislation couldn't be put into place to discriminate against those private equity owners, but it would be tricky and there would be legal issues to work through as between, whether you, Marty, as a person versus Carlisle as a legal person can own those properties. That's to be
There's already a
determined.
single family housing shortage, right? That's been
Yes.
going on for 10 years.
And
So I can't see how it's politically sustainable.
But the beauty of the strategy is that at some point in time, if they want to exit, they can exit into a liquid market. And you got a mortgage finance product ready to back them. So if it ever became a political issue, they could sell those homes into the marketplace and they could still probably make a significant
I think you had a
return on the
question.
capital appreciation.
Please go ahead.
Component.
The lady behind you, sorry, and then I'll come on you. Yes.
So this is partly personally.
Of course.
I don't ever get a chance to talk to people who really are engaged in. So there are two opposite ends of life, sort of, at least home ownership life. You alluded that I see a really rapidly growing market that I'm not sure if I see the real estate developers and owners and traffickers, addressing. So one is which is me. I don't want to own a home anymore. No thanks. Did it
Done.
for 35 years.
Right.
I live in a really beautiful home, single family home
Okay.
in the Berkeley Hills. We rent it. Love it. I don't care if I never own a home for the rest of my life. But what I would really like is to be living in a community where I know that I don't have to keep convincing the landlord that they want to keep renting. And where I might be living among my peers. So there's this idea that I've talked with many people about now, but nobody's actioned it, which is communities, especially design communities for retirees.
Nice.
Mhm.
senior citizens,
Yeah.
that are single, that are pods where you have
Mhm.
some shared resource.
Yes.
It's
Mhm.
not a big, it's not Rossmar, it's not.
Yes.
Mhm.
This is, the boomers have to change everything, so we're gonna change this too. So
There's lots
I'd
of
like to hear.
experience.
Let's let
Well,
Ken start and then we'll just go down the line.
Yeah, it's great.
Low taxation, no children allowed, over 55.
Yeah.
California.
Yeah, they're-
Really?
Yeah, and they're nice product too.
Or in Arizona.
But I also don't wanna live in a cookie cutter kind of thing.
Right.
I'd like to be able to get together with 10 of my friends and
Yep.
relations and
Yep.
say, let's build a pod community
Yep.
together. And I'd like somebody to finance it and build it.
Ken,
And then
so,
it's the other side, which is my children's
Sure.
generation, who are way less interested in being.
Ken, why don't you tackle that one first?
Well, as Marty was saying, I mean, there is that product out there today, and it continues to be developed for folks that are in the later stages of their career who just don't want to have to deal with that stuff. And a lot of money is going into that, and the product types would look like just like any other single family home that you would go to buy. And it also include amenities such as, pools, fitness centers, community
Yes.
rooms,
Yes.
golf courses,
Yes.
all the things that you would want to just kind of like, go off into the sunset and just do. So those kinds of products are being built.
Taxation is much less.
and it-
What, say it again, Marty?
Taxation is a fraction.
It can be,
You don't have
yes.
children in those communities.
You're passing through. Now, California is kind of tricky in that, there still is a little of a bit of a pass through for taxes maybe not for high school, for example. Well, there still is a tranche of money that goes to schools, but it's much less than for your for sale product. But for the other side of the spectrum, the new homeowner, it's the same thing, right? It's like the folks that, have the new baby and they don't want to live, where they have the, restaurant scene or the music scene anymore. And so they want to, live in a different environment. And as I mentioned, that product does exist. There are institutional investors and family offices that are investing in this product right now. And in fact, right after COVID, there was a little bit of disruption in capital in that space because people weren't really sure about the market opportunity. But now that we've got a few more years of it under our belts and people are seeing that it's tested, there's more and more investment in that space.
It's like post-retirement active lifestyle, right?
Right.
Yes, yes.
As they say, location. Right. It does exist in certain areas. So I'll give an example. In Marin County, you can find it right just north of San Francisco. It exists in Marin. I'm not so sure in the Berkeley area, to be perfectly candid with you, and maybe it'll come there in a few years. Maybe it's just a little bit later on. I think it's harder to do that in Berkeley, just given the politics.
Also, universities are trying to do that, right?
Yeah.
Yep.
Trying to actually.
Just in an efficiency of time, why don't we connect afterwards? I'm happy to share it with you.
Okay.
We call it single family for rent.
Yeah.
Sure.
Maybe give Larry a chance to speak and then come to you.
Yeah, I was thinking of like Sun Communities, that's well known in states like Arizona, is a perfect example, or in Nevada. I mean, you have the tax preferences, in those states. They're, self-contained communities. They're beautiful. They're really designed, for those lifestyle. And what they're starting to do is add in congregate care. So you might have one of the spouse, still, has capacity. Yeah. And then you have the congregate care, all the way to the, the Alzheimer's units, so they can still be together. So that kind of product, I think, is extremely valuable, just looking at the demographics.
Sir, I think you had a question?
He went to Penny Pritzker's V down in Palo Alto.
Yes.
Is hilariously expensive. I mean, like millions just to get in, and then monthly. But it sounds like something you'd like.
Yeah, those are, I think about, Nevada, and Arizona. Again, it's demographics. The kids are still here in California. They don't want to go to Texas. They want to go to Arizona, and they can be, or Nevada, so they want to be close. And then they could reboot, their economics too, and lower their overall, expenses.
I'll just mention one other thing, just because it's related to this, and that is we're also seeing thematically developed housing. So if you were a fan of Jimmy Buffett, bless his soul, there are Margaritaville themed communities being developed for people, again, that want to have that kind of lifestyle and that kind of amenity. And then Disney has a massive project in near Palm Desert that they are developing that will have a bunch of Disney themed housing that you can develop in. Now, Disney is bankrolling that, but there may be other similar intellectual property combined real estate opportunities to come, and they're always looking for investors. They want to use other people's money to do it. And if the opportunity sounds right, that could also be an opportunity for family office.
Let me just ask one more question, Marty. What kind of time we have left?
1 minute.
1 minute. I'm going to give that to you, sir. So my question is, and I know you've got a nice background on it. Talk about AI, artificial intelligence.
Awesome.
Talk about it in terms of this.
It's awesome.
Hang on, the specifics of how it's really helping commercial real estate. How is it being embedded in commercial real estate? Talk about AI to the group. And again, this is another area for family offices to think about investing. So would you
I think AI is amazing. I mean,
why?
Because it's going to permeate everything. I mean, it allowed the operations of the buildings to be more efficiently run from an operating standpoint, which will lower the expenses. to be able
Carbon
to
Footprint.
be able to collect the data, to be able to do the reporting, to be able to do the monitoring, to be able to do the financials, to be able to do, I mean, it's going to permeate everything.
How about bringing up the safety and bringing up the convenience of the individual going into the property? But more importantly, I think to her question, I'm 65, I'm 70, I'm now in that type of community. AI is going to be an amazing crutch to that world. Could you just talk about that for a moment and how that?
Well, it's like
will
anything.
help?
It's like anything
It's a
else.
monitoring device too.
It's like anything else. I mean, we adopted, the cell phone, we adopted the computer, we adopted the cars, we adopted the new products. We're just going to have to psychologically embrace the technology. It's going to be permeated. We're going to be affected by it anyway. The question is, how are we going to use the tool to make better decisions, at the end of the day? So we really have to embrace it, look into it and figure out how we can integrate the AI, maybe it's not directly, but indirectly, into our life to take advantage of the opportunities that the technology are going to bring us. That's what I do with my students. They're using AI right now. It's either I can fight it or I can promote it. And I decided that instead of being, making it a negative, which a lot of the academics are doing, I'm turning it around because corporates are using AI. So if my students aren't using AI, in their academics, they're going to go into the real world and they're going to have to use AI.
Well,
So I want them to embrace it and use it for a positive and not be scared of it.
absolutely. Last question for the group out there. How many of you have read Elon Musk's book? Just quick show of hands. 1, 2, I'm 3. Anybody else? Got to read it. It's just, boy, does that open up your eyes. Great book. Just try and go out there and get it. I'm just thinking artificial.
What's the name of it?
It's Elon Musk's book that just came out. It's a book all about his lifestyle and him and how he started, from basically nothing and where he is today. I'll send it to you. How's that?
He went to the most expensive boarding school in South Africa. He's not a poor person
Yes,
at all.
he did. Thank you, Marty.
But anyway,
Thank you, Ken.
fantastic. Great job.
Great job. Thank you, boys. Thank you.